Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome to the community. We have a massive episode for you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are answering the most common question a non-investor will ask. Doesn't the stock market crash?
Yes.
We're going to go through some of the data that answers, while yes, it does crash, we're okay with it. We're then going to share some actually useful rules of portfolio construction. And we're going to close it out with a community question around micro-investing.
Let's do it. So, we've all heard the famous stock market crashes.
Yes.
We've heard of the dot-com crash of the early 2000s, $6.2 trillion of wealth gone. The 2008 financial crisis, $8 trillion was lost.
We've heard of the individual companies collapsing.
Yes.
HIH in Australia, Dick Smith, WorldCom, Enron. The stock market and individual companies collapse.
Yes.
That makes headlines around the world. The recovery only gets covered in the back page of the business section.
Yeah.
But that's where the real power is. And this is the answer when people are worried about a stock market crash.
Yes. We're here to change things. We want the recoveries to be making headlines. But we have a story that illustrates the recovery. This is probably one of our favourites. And at a time when Ren and I were late in our high school days, and it was the 2008 financial crisis. One of the biggest American banks to collapse was Lehman Brothers. It collapsed on a Monday the 15th of September. Let's say that you invested in the overall US stock market on the Friday before the collapse. In the 6 months after Lehman Brothers collapse, you would have lost about half of your money, down 46% as of the 6th of March 2009. Makes sense. However, 10 years later, if you'd held on, you would have more than doubled your money, up 132% as of 12th of September 2018.
And I think that's not including dividends as well. I think if you include dividends, you get closer to tripling your money.
How good is that? Did that make the front page? No.
And I think if you look at people that build big fortunes through the stock market, like living through stock market crashes is just the name of the game. It's part of investing long term, and it's part of the journey to building wealth. Classic example, we always go to Warren Buffett. How's this? He's the world's fourth wealthiest person, and he's lived through 15 American recessions, 1929 to 1933. Now we're kind of cheating with this one because he was born in 1930.
Yes, technically.
1937 to 38, 1945, 49, 53, 58, 60 to 61, 69 to 70, 73 to 75, 1980, 1981 to 82, 1990 to 91, 2001, 2007 to 2009, and 2020. Despite all of those stock market crashes, those American recessions, he's built a $100 billion fortune.
It's crazy.
It's just like the stock market crashing is part of the journey. It's not something to be avoided.
No. Now, there was a study done. It was the largest study of stock market returns. It was done by 3 professors, Elroy Dimson, Mike Staunton, and Paul Marsh. Now, the professors looked at returns after inflation and found that a $1 investment in the global stock market in 1900 would be $295 in 2000.
After inflation.
After inflation.
That's pretty good.
Yes. They also calculated the real 100-year returns of stock markets around the world. Now, some of the best... Surprisingly, Sweden at number 1, 7.6% per annum, turning $1 into more than $1,500. Australia came in second at 7.5%, South Africa third at 6.8%, and the US fourth at 6.7%.
7.5% after inflation for Australia. Pretty good.
Pretty good.
Yeah. Now, the professors wrote, put this in a book, and they called the book Triumph of the Optimists, 101 Years of Global Investment Returns. The reason that they called it Triumph of the Optimist, the reason that we wanted to talk about stock market crashes to kick off the show today is because the stock market made investors all of this money despite plenty of reasons to be nervous. Every decade in that time period that these professors studied, there were catastrophic events. There were events that would have had investors fleeing for the exit and thinking, I'm not going to invest. It's not for me. I'm not going to take the risk. I'm going to put my money somewhere safe. The 2010s, the Spanish flu, World War I, 20s, Great Depression, 30s, the start of World War II, the 40s, the start of the Cold War, the 50s, the Korean War, the 60s, the start of the Vietnam War, the 70s, stagflation, the OPEC oil crisis, the 1980s, there was the 1987 Black Monday crash, the 1990s, the Asian and the Russian financial crisis. Every decade there were catastrophic events, and every decade that we invest in the 2000s, there will again be catastrophic events, but the stock market grinds higher in spite of all of those.
Yes. So if you've just joined us for the first time, you're wondering what is going on with the stock market, why we have done a podcast for the last 7 years talking about it. This is why. The stock market crashes make front page news. The recoveries never do, but they're the most powerful part of the stock market story, that businesses just keep recovering, stock market just keeps on churning away.
And the reason that we're confident it will keep doing it is because the stock market is just a reflection of, it's an amalgamation of collective human effort to come up with new products and services, new innovative ways of servicing people and giving people what they want, of business model disruption and technological change. It is just a reflection of the overall productivity of the economy in the world. And as humans keep doing what they're doing, the stock market will continue to do what it does.
All right, Ren. Well, second part of this episode, we've had a lot of Pimp My Portfolios of late with Luke Larrative and Adam Dawes as our experts reviewing our community's portfolios. And what is becoming a recurring theme from both of our experts is portfolio construction rules, specifically commentary around not wanting to have positions or, I guess, investments in stocks less than 5%, more than 10%. So we thought, why don't we actually take a step back and look at some actually useful rules of portfolio construction and contextualize why these guys might be saying it.
Yeah, and I think it's doubly important because portfolio construction and rules of portfolio construction can be super vague. Like when we're preparing for this Find Online, they'll have things like step 1, consider your goals, step 2, your risk tolerance, step 3, determine your asset allocation. And it's like they're important bits of advice, but they're not actionable. You know, they're not like hard and fast rules. And so what we wanted to share was some actually useful and practical rules that you can apply to your personal investing once you've done all that general stuff of your goals and your risk tolerance.
So the first one that we have here is that 100% in a multi-asset portfolio is enough. And I think broader to that is everything that you hear experts and professionals talk about might not directly apply to you because you're not running an individual stock portfolio.
Yeah, let's start there. So when Luke or Adam from Pimp My Portfolio would say, you want to have position sizes of sort of between 5 and 10% of your portfolio. That is a rule for individual stocks. And so if you're building a portfolio of individual stocks, it's a really good rule of thumb. But when you're looking at different assets, and in this case we're talking about ETFs, that rule can get really confusing and doesn't really apply as well because ETFs in themselves are made up of multiple stocks and can be a portfolio in and of themselves. And so that first rule that you mentioned is all of your money in a multi-asset portfolio can be enough. And what we mean there is a Vanguard diversified high growth or a Beta Shares diversified all growth, VDHG or DHHF. They're designed to be like all-in-one portfolios. And if that's all you have, that's fine.
Yeah.
That's enough. And so don't worry about professional managers saying no more than 5 or 10% of your money in any one thing, because those multi-asset ETFs are the portfolio for you.
Yeah. All the principles that go into portfolio construction, like rebalancing, diversification, like, you know, these products do that all for you. So rule number 1, 100% in a multi-asset portfolio is enough. Rule number 2, or useful rule number 2, diversification and weighting rules don't apply to ETFs. You kind of alluded to it there, Ren, but when we're hearing our experts say 5% or 10%, obviously I'm not sitting there going, oh, I've got 35% in an S&P 500, I need to be dropping that down to 5%.
Yeah.
Because ETFs by their nature are diversified, and for that reason, you're not needing to be worried about concentration risk.
Yeah. Now I'm just imagining someone clipping you saying they don't apply to ETFs, and the principles still apply. You know, like diversification is important. It's just that like these products are already diversified in some ways, and then it's, you know, like, for example, the ASX 200 is a diversified portfolio across different sectors and industries and stuff like that. It's just not geographically diversified. So then you want to add geographic diversification.
Yes.
But yeah, it's just like there are all these hard and fast old school fund manager rules that don't quite apply in the same way to ETFs.
Number 3, Vanguard founder John Bogle, he advocated using 120 minus one's age to determine equity allocation. So what he's saying here is, if you're thinking about how much exposure should I have to equities versus other asset classes, his rule of thumb, 120 minus one's age. So for me, that would be 120 minus 33, so 87% to equities is what he's suggesting.
Yeah. For me, 120 minus 31, yes, I am a little younger than you, 89% to equities.
Yeah.
Where this is particularly relevant is you will often be given a number of like model portfolios to choose from, or in your super you might just be given some buzzwords to choose from, and it will be things like conservative, moderate, growth, high growth. And knowing what asset allocation makes sense for your age can be confusing, because someone might be 20 but they might not be comfortable with risk. They may not have heard our first segment on doesn't the stock market crash? Yes, but it recovers. And so they might err towards conservative. But that doesn't really make sense for their stage of life. Generally, general circumstances, not being aware of personal situations, doesn't really make sense to make that choice. And so this rule of thumb by John Bogle is a way to, I guess, inform that choice. Yeah. So, you know, if you know, you're sort of our parents' age and you're 60, you say 120 minus 60, you might have 60% weighting towards equities. So that's a lot more conservative. If you're, you know, in your retirement
Warren Buffett,
and you're 80, you might have 40% towards equities. In some ways, it feels a little aggressive still, doesn't it?
It does, yeah.
I've also seen this rule of just 100 minus your age.
Yeah, seems a bit better. If you're in your 80s, 20% to equities.
That seems a bit better,
yeah.
But to be honest, the John Bogle style of the rule works better when you're our age.
Yes, yeah.
Because I wouldn't be saying 100 minus 31. I wouldn't be saying 69% allocation to equities. Anyway, it's just a good rule of thumb to start thinking about how your asset allocation should sit based on how many decades
where you are
left.
in life. Yeah. And then finally, for individual stocks, something that has really shone through doing Pimp My Portfolio is we've all at various points in time put a little bit of money here, a little bit of money there, and ended up with a bit of a accumulation of stocks. There is some academic research that shows the benefits of diversification actually start to erode after you have 15 to 20 stocks in your portfolio. Now, again, this is for individual stocks, not talking ETFs, but yeah, something to keep in mind if you are building out an individual portfolio. The risk v benefit of diversification deteriorates as you start moving beyond 20 stocks.
Yeah. So there are 4 rules, depending on different portfolios, that you can, I guess, apply to your own thinking. Because it's not one size fits all, but to start at the top, if you're just dollar cost averaging into one of those multi-asset pre-prepared portfolios, don't worry about the rules saying you need no more than 10% in one thing. That can be your whole portfolio because it is designed to be a whole portfolio. Secondly, ETFs are different to stocks, and so different diversification and weighting rules can apply. Again, that 10% max, 5% minimum rule is the one that we're really pointing to there and saying don't worry so much about that. Thirdly, this 120 minus your age to think about asset allocation. And then finally, if you're building an individual stock portfolio, you don't want to become a collector and have 50 lines in your portfolio. The benefits of diversification are eroded after sort of 20 positions.
Nice. Well, we're going to take a quick break, and on the other side, we're answering a question that has come through from our live Melbourne event. Is micro investing worth it with the current high interest rates? We will be right back.
Welcome back to Equity Mates. We're about to answer a question around micro investing and whether it is worth it. But before we do, I just want to give a quick shout out to everyone who has contributed to our growing list of companies with the best moats. This was something we launched last week on the podcast, and we are trying to compile a comprehensive list of the companies with those powerful, sustainable competitive advantages that will allow them to be great investments for years to come. To give you a sense of what's coming through, Bryce, I want to share a couple with you. It's been amazing the number of people that are talking about big tech. So Facebook with its network effect, pretty hard to disrupt. Another one that people have been sharing is Apple. The network effect of being on the iMessage system and being able to be part of the group chats.
Yes.
You can't, tough to get out and go to Android and fall out of all your group chats.
Yes.
So that's an interesting moat there. One that I thought was quite interesting was some of these waste companies. So access to landfills can be a captured resource. So Cleanaway down in Melbourne was one that was pointed to as an example. They have like the biggest landfill. It might even be the biggest landfill in the Southern Hemisphere. And they're not building a lot more landfills. And so Cleanaway have this captured resource that allows them to basically dominate that market, and all their competitors have to go to them.
Tough to elbow in on.
And so I thought that was an interesting moat that I hadn't really thought about.
Nice.
So if you've got any ideas of companies with really powerful moats, equitymates.com/contact. We are trying to build the most comprehensive list, which we'll then share. So
love it.
Get on it.
Get on it. Let's build that list. All right. Well, we had a live event in Melbourne, and part of it was Ask an Advisor. We had way too many questions to get through on the night, so we're going to try and get through some on the show. And this one came from a community member on the night. Is micro investing worth it with the current high interest rates?
Yes. Next question.
Done.
Now, look, it's a good question because investing really, at its core, is about taking more risk for the opportunity to get more reward. And you can essentially chart every investment out on a risk curve where on one axis it's potential gains or reward, and on the other axis it's risk. And you should only be willing to take more risk with your investments if there is the opportunity to get more as a result. 4 or 5 years ago, when interest rates were next to nothing and we weren't getting anything from our savings, micro investing with its long-term average expected return of around 8% made heaps of sense when you compared it to 1% in your savings account. But times have changed. Interest rates have risen, and now we're comparing 5.5% in our high interest savings account to an expected investment return over the long term of 8%. But that 8% isn't guaranteed, and it's certainly volatile. So that differential, is micro investing worth it? Worth the extra 3%? Yeah.
I mean, on a mathematical equation, yes, if you're in it for the long term. But look, I think that this is if you're starting your investing journey, if you're looking to build wealth over the long term, that's just, for me, that's not the way to look at it. I think the habits that you get into far outweigh the I guess, trying to make that risk-reward decision. And for me, micro-investing is all about dipping your toe in the water, getting into the habit of investing small amounts, letting them grow, understanding what your investments are going into, how you might see, well-diversified multi-asset portfolios, and then understanding who you are as an investor. So I think all of those things, if you're micro-investing, I don't think you need to be worrying about what is the interest rate doing and is it worth just putting my money into a savings account.
Yeah, I think the other thing is the difference doesn't feel like a lot now, but we're not talking about the difference in a couple of years. We're talking about the start of almost a lifelong journey of building wealth. And so I've just run some numbers on the Money Smart compound interest calculator. $20 a week invested for 40 years at 5% gets you about $130,000. If you just up that percentage to 8%, it gets you over $300,000.
Well, there you go.
And so it's just like those small differences that is at its core the power of compounding. Small differences in your annual return consistently grow and grow over time, and that gap gets bigger and bigger. And so I think to the question of is micro-investing worth it, it is, because even those small differences are the start of a much bigger wealth building journey, on top of everything you said about learning about how the stock market works and growing that investment over time and building those good habits. I guess my final point would be they're not mutually exclusive. Whereas maybe a few years ago you would have been putting more of what you were saving from your salary into the micro-investing app.
Definitely.
You can now spread it, and you can, earn some from your high interest savings account, and you can earn some from micro-investing. But I think it would be a real shame if you didn't try and get started, because who knows where interest rates are going.
Yeah.
But as we started this episode with, and as we keep coming back to on this investing content journey that we're on, the stock market has just been a proven, consistent performer over time.
Greatest wealth creating machine in history, one could argue.
One could argue.
So thank you for that question. If you have a question that you'd like to submit, and we'd be happy to answer on the show, you can either do it via a voice recording or you can write it in at equitymates.com/contact. We'd love if you could leave a voice recording so that we could play it on the show.
And while you're there, share your companies with moats as well.
Share your companies with moats. There's plenty. It's a one-stop shop form where you can essentially fill in all the details for any part of this show.
You can leave your portfolio for Pimp My Portfolio.
Yes,
it's all there.
It's all there.
But look, I think that will do it for another episode. A massive thank you for listening. Wherever you are on your investing journey, we hope it helped.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.